Business is simple. It's just not easy. We focus on 3 things to help you run and grow your business more easily: talent, sales, and how to scale. This is the Talent, Sales, and Scale Show. Hey everyone, Bryan Whittington with this episode of the Talent, Sales, and Scale Show. We have a cool guest on here. Brian Baum spells his name incorrectly, but I won't hold that against him. But Brian Baum, he is the managing director of Interchange Capital Partners, and he's the local chapter president of the Exit Planning Institute. And today we're going to be talking about how in the world do we build our business to maximize our exit multiple, because that's what we're in the business of doing. Yes, we're in the business of helping communities thrive through entrepreneurship. Yes, we're in the business of making our customers super happy with us and delighting everyone around us. But really, in reality, this is the investment that you've made, and you're looking for that ROI at the end of the day. So that's what we're going to be on today. So with that said, welcome to the show, Brian.
Thank you, Brian, who spells his name incorrectly.
Well, that's why I can't spell. I can't even get spell check to work on that. So the number one question that we always kick off with, Brian, is what in the world makes you such an expert? Yeah. So you're the president chapter of Exit Planning Institute. Yeah. So you do financial planning and you're dealing with all of these businesses who are working to maximize their exit profit, or maximize their profit as they exit. But what in the world makes you such an expert on this? Why should we listen to you?
I guess the easy answer is you don't have to listen to me, but let's talk about what not listening to me actually causes. It's a less profitable company. It's a less profitable exit. It's a near guarantee that you fail a succession plan with your kids or your management team, and a whole host of other stories. So what I tell people is you don't have to listen to me, but those that don't become the best stories that I tell others that do.
All right. So a little provocative. I love it. So now thinking through this, you talked about the keys. What are the keys that you would suggest that we need to do to maximize business value? Is it just sales? I mean, is that what we should focus on, or how can we maximize business value?
Well, I think first we got to start with business value. We need to start looking at our companies not from this emotional point of view, but it's an asset. It is designed to provide a certain lifestyle for our family. And if we sell that asset, then we need to make sure that the proceeds of it can continue to support the needs and wants of the family and the shareholders that have it. So by focusing on value, you end up getting more revenue. You have a more profitable company. You have more engaged employees. You have all of the systems and the processes that a buyer would want on the other end, whether that buyer, by the way, is your son, your daughter, your management team, or an external third party. It doesn't matter. When you build a business and you focus on value creating action items, you're getting everything that you want anyways. We don't have to pick and choose any longer.
Now, that's an interesting thing. So and I guess that was a question I was going for, but poorly asked. What are the key tenets or the key things that we should be focusing on to increase that value?
Yeah. So, I look at this and I say that, there's 4 different types of capital within a business. Of course, we know that we've got the financial capital, but we also have the human capital, which is our employees. We also have the systems capital, which is all the systems and the processes that we have. And then we've got the social capital, what's our impact within the community. So when you look at that, only one of those 4 has anything to do with, dollars and money. Everything else is intangible. And I think what a lot of people don't recognize is, yes, you can have a very large company and you could have a significant EBITDA, which is earnings before interest, taxes, depreciation, and amortization. And all of that's great. But if your company doesn't have some of the intangibles and you can't tell the story of why you're more valuable or successful, or you've built something that others envy, then an arm's length transaction, a person on their side is not going to view you as valuable because they just don't see and feel everything that you're saying. You can't prove it effectively. So a lot of what comes down to value is, can you prove it? So by way of example, a client of ours had a significant amount of money in their inventory. And we were going out there and we were trying to argue to buyers that they should be compensated dollar for dollar on inventory. Now, that's not really something that typically happens, but they didn't really have any debt. They funded it all out of cash. And we felt like, no, that's an asset, like that should be added in. But we had nothing to back up the validity of the inventory, the fact that it actually still was, properly managed and maintained and wasn't, didn't need to be written off. So we had to go in with them. We had to write out this very long policy and procedure of how do they do inventory management? Because we knew that eventually a buyer was going to say, okay, I might be able to get behind paying you for it, but how do you manage your inventory? And our answer at that point in time cannot be, well, Susie over in accounting sends an email out to all the team and says, hey, do you have these SKUs? That can't be our answer. It needs to be documented. And then we have to have further proof of that documentation in the way that we have been operating for years.
And that's
one example of value.
Yeah, and that's the curious thing, Brian, right? Because whenever I started looking into this a couple of years ago, it blew my mind that in order to really maximize your exit multiple, it doesn't come down to much other than running an effective business, running a good, sound business with systems and processes and people in place with good financial stewardship and reporting. I mean, if I wanted to maximize my exit, is it really that simple? Not that that's simple to do, but is it that simple as the idea to have?
I think it's simple to conceptualize.
Absolutely.
It's harder to implement.
Yeah. So talk to us about a couple of different stages. Whenever I'm just starting off, right? So, and remind me to ask about different segments of the business too, or different verticals, but whenever I'm just starting off the business, should I have my exit plan in place or think of how I want to exit this? Am I exiting to family members? Am I exiting for a long-term? Am I going to have a long-term hold for succession there? Or am I going to really, my next succession plan is another tranche of money from a VC or a private equity? I mean, should I have that in my mind as soon as I start the business?
It depends on what type of business you are starting and how you are going to fund the growth. If you are raising money from a venture capital firm, they're going to want to know that you've got an exit in the future because that's how they receive a return. But if I'm starting a business and I'm bootstrapping it and it's my company, I would say, no, you don't need to have a future exit in mind. What you need to have in mind is you need to have what are the value milestones that I am trying to hit and what does my company look like at each of those milestones? Because whenever we focus, and I'll go back to what I said in the beginning, when you focus on value, you ultimately will open up all of the options from an exit perspective anyways. When you don't focus on value, then typically we've got a few of those exit option doors that are shut. And the only time that someone learns that they are shut is at the end. And to open those doors back up, it takes another couple of years and they might not be willing, able, or want to continue down the road for those extra couple of years to reopen a door that they might really want to walk through. But because of how they ran the business or how they ran some of the personal finance aspects of their own life, some or all of those doors could be closed to them.
But it's interesting. So you talked about value milestones. So unpack that a little bit. What are maybe some value milestones that we should consider?
Sure. So, the first is, we should really understand what the industry margins for our business is. So, what's a healthy gross profit margin? What's a healthy, net income or EBITDA margin? And then how do we measure our company on an annual basis against everyone else? Because I could think that my company's going great. I made $1 million of revenue. But if I spent $900,000 on cost of goods sold, and now I've got $100,000 left in gross profit, and I still got to pay everyone else, there might be next to nothing left for me as the owner, or I might be putting more money into the company. Probably doesn't sound like a great business to be in. So I think understanding first, what do those healthy margins look like? And then how do I strategically angle to be at the top tier of that? So I always say that the most valuable business are the ones that are pushing far beyond what the industry average is. So if the industry average gross profit margin is 50%, I want to find my way to 60. If it's 30, I want to find my way to 40.
Now, how do you work with companies, or how are companies really looking to do that? Because it's easier said than done, right? The idea is, okay, yeah, just add another 10 points to it and you're good to go. I mean, how are you seeing people do that?
I think that one of the things that we do is we look at something called a cash conversion strategy. So this is all of the ways that we can either bring cash in faster, so increase our cash flow, or we can delay payments out. But on top of that, it also has to do with inventory purchasing and other things that will make for a healthier profit and loss and a balance sheet. So we take people through this, and it's a little uncomfortable for them in the beginning because I'm challenging sometimes industry norms, but I'm also challenging status quo that they have. So, one example is I was talking with a client, and we had this challenge where customers were not giving him the hours that he was used to. He was used to being able to work 6 hours a week, and now he's only able to work 2. But he's getting more business from them, but the cash is dribbling in slower. So we looked at that and we said, well, is there some type of a guarantee that we can come back to the customers with that will make them comfortable with giving us that 6 hours a week back? So for example, could we give them a guarantee that says, we will be done with this project no less than 90 days. And in that 90-day period, I want my 6 hours a week worth of work to come back to me. But if I go past that 90-day mark, you stop paying and it's on me. It's an interesting way, because now you basically told them, you said, look, I'm guaranteeing you're done in 90 days, paying and hopefully with the project. But at the same time, I need this to be able to do that. You're going to pay it over the long term anyways. I'm just saying pay it sooner. So we're starting to implement that slowly, and we've received some pretty good feedback already from people whenever we shared exactly why this is important and how this impacts them and how it's going to impact the end user ultimately.
Yeah. So then again, that's not much to do with the exit strategy. It goes to run a good business, right? Creative problem solving to de-risk the sales so you can get additional revenue coming in. And then you're talking about cash flow conversion strategies. If you're looking for a resource for that, Scaling Up has a good resource for that. And we'll hit some...
I stole that directly from Scaling Up.
Oh, did you? Nice. Okay.
Yeah.
So it's a great resource if you want to get a little bit more sophisticated in how you're running your business. Now, what are some other milestones? So we're looking at profit margin, EBITDA, making sure that we're good there. What are some other measurements that we should look at?
There are size milestones as well. So as a company grows, you naturally start hitting this uptick of multiple expansion. So a $1 million company or 1 million EBITDA company is not going to be as valuable as a 5 million EBITDA company. And that 5 million EBITDA company is not going to be as valuable as a 10 million EBITDA company. There is a natural expansion. People are willing to pay more with the more money that you make. So there are these multiple expansion moments in each industry where if you hit this inflection point, if before you were somewhere between a 6 and an 8 times multiple, now you might be between an 8 and a 10 times multiple. And all I did is I just increased the size of my company. So again, it goes back to value. If you want to increase value, size is a component, but I can't just grow the top line. I've seen companies that have continually grown their top line, but they're bringing on more debt and their EBITDA might be looking like it's going up. But then whenever I sell the company, and this is very interesting, when I actually sell the company and do a cash-free, debt-free transaction, if I were to do the same calculation 2 years ago versus today, even with the increased revenue, even with the increased EBITDA, but because now I have more debt, I can end up with the exact same amount of money.
So grow for wisdom's sake, don't grow for all out sake. So now let's talk a little bit about the multiplier. What are some of the things that can go into the multiplier? So we talked about size. What else are we looking at?
I think you want to show that you've been growing consistently. You don't want to necessarily try to transition your business, especially to a third party, whenever you've had a down year. They're going to look at that and say, well, why'd you go down? Maybe COVID is a good reason, but everyone pretty much came back pretty quickly. If you haven't come back quickly from that, then buyers are probably going to be a little skittish until you get back to pre-pandemic levels. But largely, I think you're looking at performance and a history, a growth trajectory that, hey, we've grown every year pretty consistently. Here's our compounding annual growth rate. Outside of that, you're going to want to have really strong customer contracts. I can't tell you how many times I talk with someone and they say, oh, we don't have contracts with people. They can leave at any time. I'm like, if they can leave at any time, that's a risk to you and that's a risk to a potential buyer. We need contracts in place. We need a legal paper document that says if you want to break this, there's some penalties around it, because that gives comfort to someone who doesn't have the relationship. Because if they buy that company, you're leaving, i.e. your relationship to all the customers is leaving, and they have to step in its place. And that paper that you would have had a customer or a client sign, that's their protection. So if we don't have customer contracts, that's a material risk. Another one that I can think of off the top of my head is, I had it a moment ago too. This is a simple one, customer concentration. But I'm going to take it a step further, vendor concentration. I think a lot of people were exposed during the pandemic where they got all of their raw goods or whatever material they needed to make their products for customers from one supplier. And they saw the extreme adverse effects of having only one person to call. You are now at the sole discretion of how quickly they can get it to you. So vendor diversification is something that isn't thought of enough. Who are my A, B, C, D, E vendors? We typically have more customers than we do vendors. And that makes sense. We got to manage vendors a little bit differently. We get pricing power, but I think we always need to have backups of who we are getting and sourcing materials for that allow us to deliver the products or the services to our customers.
Got it. And so let's hit on the cut, or staying on this topic, the customer vendor concentration on customers. What's the concentration breakup that we want on customers? Because I know that's a big one.
I think you want to avoid what I call the death customer.
And Walmart.
Well, I mean, yes, you do not want to. I don't know how many times I've had business owners try to argue that, well, yes, this is, this company is our customer, but I have 10 different locations, and that doesn't matter. It's one company at the end of the day. It's one company paying you. I don't care how many locations you are in. That's fantastic. Good for you. But that one company can shut everything down like that. And they can eliminate you from all 10 simultaneously, immediately.
So what's the biggest amount of revenue per customer that buyers feel fairly safe?
I think that you want to keep your top 3 customers. So this is your top 3. So I'm taking it a little bit further. You want to keep your top 3 customers under 25% of your total revenue when possible. If you have one customer over 25%, I would be very, very worried, and I would be working like hell to be able to speed up development of other customers to be able to systematically dilute them down whenever you're looking at it. And that's something that, I mean, even myself in my business, I'm constantly looking at who are our largest clients and saying, how do I get them to be smaller? Yeah. Proportion to everything else.
Now, okay, so far we talked about influences on the impact or how to improve the exit multiple. We talked about sustained growth, and that sustained growth should be at least a minimum of 3 years. Is that fair?
I think you want to show a 3-year trajectory. That's typically how far back they will go, but diligence goes much deeper than that. They're going to look at everything. But to start, 3 years of consistent growth shows a trend. 1 year can be a blip, 2 years can be a blip, 3 years, okay, we got something here.
Got it. Okay, so we want at least a minimum of 3 years growth. And then what you just said there is a rationale of that why this is actually sustainable. Then we also want to make sure that we're locked up on contracts. We want to make sure that we have a good distribution of customer revenue coming in, as well as vendor concentration, so we don't get stuck there. I know there's a couple more. What else?
One that I can think of off the top of my head is, if you are going to sell your business, if you've decided I've got no next generation, my management team either can't do it or I need more money from it, then hiring the right team around you at that moment in time is so critical. And that is not, and I know this coming from me is going to be cliche, but I've heard it from entrepreneurs. So imagine I'm the entrepreneur telling you this. Do not be cheap hiring advisors. Do not try to save $100,000 whenever we are talking about tens of millions of dollars. We are expensive for a reason, and it's because we're good. That's just hands down, period, end of discussion. If you go with cheap, you're going to get cheap. You're going to miss things. You're going to learn about them later, and you're going to be very, very upset with the result. If you hire someone who you feel is expensive, they're probably actually fair. And if it's way too expensive, obviously you will know that. But hire the right team around you. And then when you have that right team, make sure they're in constant communication with each other, and they are thinking about, how do we structure this for your and your family's maximum benefit post-transaction. I don't know how many times someone is hired, especially on the M&A advisory and the investment banking, and our bogey is only to maximize the business value. Well, that's fantastic. But if I don't structure a transaction appropriately, maximizing that does only one thing. It makes my fee higher because I get paid off of the aggregate value of the deal, but it doesn't necessarily translate to more money into your pocket the way that it potentially could if we had a couple strategic ideas ahead of time to be able to think about how structure will work post-transaction and maximizing that family's post-transaction net worth.
All right, and a couple of others that I believe are within this is, I thought you were talking, so that was really hiring a good M&A team, right? Good advisors around you so you can maximize there. I was expecting you to say people on your team, so having a good team, not just in a leadership management, but a good team on.
I think a CFO is critical. I mean, there is a difference whenever a company just has a controller versus a true chief financial officer and someone who knows the numbers inside and out. They can dig up different reports. They can adjust the reports for what a potential buyer might want to see. That is such a critical component that is oftentimes overlooked. A controller just doesn't cut it. Especially, it might if that controller is just a controller in name only, but you really need someone that is experienced with what a buyer is going to ask for from a diligence perspective. How do you want to present things? What do you want to present? What don't you want to present? And then more importantly, what are the footnotes that we have to add into those financials to complete the entire story and make sure that everything tracks across all of them?
And then to go to that CFO and something that you tied a little bit earlier about, how are we funneling the money through the business, right? Is it our corporate retreat on the beach just for our family and our, right? So do we have clean financials that people can trust? I know is a big one, because what do they call it? Holdbacks, or whenever they have to go back and correct something?
There's an earnout, there's a holdback. There's a adjustment of working capital. There's a number of things that are typically built into the transaction, and it's all supposed to mitigate the buyer's risk.
Yeah. Okay. And now, so those are all key areas that we should be focusing on to help maximize that area. So make sure that we have continuous growth is one of the reasons that we do this, right? Is talent, hiring the right people, sales. How do we market? How do we sell? And then lastly is scaling the business. We have to keep an eye on all of these whenever we're looking to scale the business. So whenever we are ready, whether it's to, get a tranche of money from private equity, or we get another funding round, or we go into succession with our family starting to take over, or somebody else starting to take over, or we put in a proper leadership management group so we can have full ownership of the company, but enjoy the life that we've poured into. to get that return on our time and the investment. These are all things to consider. So let's transition to that succession plan. When we're thinking about succession, how long should we start to plan? How long in advance from our, hey, want to be out of this for the most part? How long does it take? What should we be doing? Can you talk a little bit on that, Brian?
Yeah. So for this, I'm going to start with everyone that I've talked to has something that I've come to start calling the rolling 3 to 5 years. So what this means is that every person I talk to, and I ask this question, well, when are you going to start working on this? 3 to 5 years from now. And I've asked the same people in 3 to 5 years, and I asked them the same question. When are you going to start thinking about this? Oh, 3 to 5 years. And you just keep rolling this 3 to 5 year idea. And the rationale is that we inherently don't have something more exciting that we're going to. So if I am going to transition my business, I'm not going to work in it any longer. I'm not going to be there any longer. But I don't have anything more exciting to do afterwards that I'm really energized about, then I'm going to procrastinate like hell to not actually start this process. So that's one aspect of it. So people just inherently think that I'll start this in 3 to 5 years. No, it's not a very quick thing. You don't just start it and then finish it. And even if you think that you do, you say, well, I'm going to sell it to my son and I'll take back a promissory note and that's how we'll do the transaction. Well, then you have to hope and pray that he sustains the business while you're no longer there for 10 years to pay them out. It's a long time, especially if you haven't done all of the other things to build the value and the son potentially hasn't really been involved because maybe you didn't really let them be involved. There's a number of risks that inherently come together. So in my world, what I try to do is I say, look, if we break down what a succession plan is, and we say that it's not about the end, it's not about the exit, it's not about leaving, but it's actually about how do we build a valuable company so that when we leave, whomever takes over, we're not concerned about the business's prospects because it's not actually on them for it to succeed or fail, but it's actually the system that we designed. And it's the people that are in there running the system that we designed. So we start building a business that is more turnkey, more automated, more scalable, that allows for a replacement of human emotion, human error, human influence, and is just designed to service the customer and create a great product or a great service that's really going to wow them.
Now, do you have, because part of what you do, Brian, if I'm not mistaken, is really helping organizations to identify different business processes. Is that right?
Yeah, it's definitely a component of ours. We tend to outsource it when it gets too in the weeds, but we at least high level start thinking about what's the workflow, what's the process, does this process still make sense, is it documented somewhere? If I remove this person from your company, how painful does that, how much pain does that cause you? If that person leaves tomorrow, what don't you know? What do you wish they would have told you? And how long is it going to take for you to get back up to speed?
Yeah, so being able to transfer that tribal knowledge throughout the organization is so vitally critical. We talked about the different stages that, you talked about a $1 million EBITDA or a $3 million EBITDA, or the higher the growth is, or higher the larger the revenue that thing's thrown off, the better the multiple. So if I'm building this up to sell, if I'm building my business to sell, is there a bare minimum? Let's say I'm a smaller company. I don't have a bunch of VC backed. I'm not out in technology. Is there a particular minimum number that I want to hit?
There's not a minimum number any longer because there's a number of MBA graduates that are coming out that are following what's called a search fund model, where they are looking for historically smaller businesses. So these are businesses from maybe 250,000 of EBITDA up to maybe $1 million-ish, maybe $1.5 million on the high end. So they've become the buyers of a lot of these. You may also benefit from a roll-up strategy from a private equity firm as a bolt-on acquisition. They might just want to grab up a bunch of them, put them together, and continue to grow. So I wouldn't say that there's a minimum, but I would say that you need to match up what the proceeds are that you're going to receive to your lifestyle. Because a lot of times people say, oh, I'm going to sell my company, I'm going to make $5 million. And they don't even realize that they took a pay cut by doing it. Like if I have a business that makes $500,000 for me every single year, but I only get $5 million after taxes. So let's do some quick math. If we assume zero growth, which I don't believe would happen, but you've got 10 years. If you just straight cash flow that, you've got 10 years of cash left. And especially if you never saved anything along the way while you were making all this, but you're spending every dollar, you're in even more of a dire situation. So, in my world, I'm trying to constantly bring together two historically competing worlds, the business and what it needs, and the family and what it needs. But yet these two really need to start working in harmony and moving down the path together. They are the same. There is no difference whenever you have a closely held private business. I don't care how large that business is. If it is closely held, family run, family operated, those two worlds collide almost every single day.
Now, does this stuff only apply, and I think I know the answer, but does this stuff only apply to more traditional businesses, right? The old mature markets, or does this also relate it to, SaaS, hyper growth, unicorn type companies?
I'm glad you asked that, because I was joking around with a friend of mine. We heard of a company that sold, and it sold for a ridiculous number. It was like 100, maybe it was like 200 million. And it was VC backed. They raised a ton of money. And we were joking around. We said, how much do you think the founder got out of that? Because at some point, they dilute themselves faster than they grow their value. So they could raise 10, 20, 50, $100 million. But when it comes time to sell, because of all these pref rights and other things that are built into these venture capital contracts, they might end up with $5 million for a decade's worth of work, while all their investors reap much larger rewards. And it's not really until their second or their third successful company where they have funded the majority of it to get into its first major inflection point where they end up making a lot for themselves. And I see that story play out a lot. And I don't want to say it's unfortunate. I think it's a reality of how some of those companies just need to get up and running. But the more that you can do in the early days of a company like that without taking on investment, the better off you'll be in the future. So it's almost resist the urge to take the money from the people that are throwing the money at you. Like, I get it. If you have that great of an idea, go sell it. Go start selling it. Do the Apple model. I think Steve Jobs, what did he do? He sold like 40 Macs before he ever took $1 of money, and he put it all on a credit card and paid off the credit card in 30 days after he built and sold all of them. So we went out and got some real customer feedback. You can have the best technology in the world, but you got to have someone to pay for it at some point too.
Yeah, and you bring up a good point, right? The thing that keeps coming back to my mind, or where I've been focusing on, is that, do you have product market fit? Can you identify your ideal customer profile and all the personas? And then do you know how to engage them, convert them, and then delight them to keep them, right? I mean, that's business. That's how you do it. And you have systems and processes and people in place, technology to do that. And so what I'm hearing you say here then, Brian, is if you can bootstrap it. Have maybe slower growth up front. Yeah, it's going to suck. Yeah, it's going to be you. And I'll tell you a horror story on my end is I tried to put the right people in place. I tried to hire the people who I thought were the leaders to do this, and they weren't able to do it. So if you don't have the right systems and processes in place with repeatable, trainable, you're not going to be able to do this. So take that slow growth up front, because you don't typically die from starvation. You die from indigestion, from doing too much too quickly, and it all comes at you too fast. But that's my thought. I don't know if I'm all wet on that, Brian.
No, I think you're spot on. And full disclosure for everyone that says I don't know what I'm talking about from the VC community, I'm currently incubating my own financial tech company at the moment. I've spent exactly $0. I have hired no one, and I have leveraged all of my network to get to a point where the first dollar I spend will actually be to develop the MVP, but I've already figured out who my customers are. I know who's going to buy it. I know who's going to fund it. I've got the entire roadmap already mapped out, but I have spent exactly $0 to get to this space.
Interesting. Well, we can't wait to hear more on that. You'll have to come back whenever you start doing this.
Well, it still could die at any point, Brian.
Well, we have hope, right? We have hope. All right. Well, let's. So we talked about how do we build this up? Systems and process, really good business value. We talked about the different leverage points that we have: sustained growth, contracts, customer vendor concentration, leadership and management team, especially a CFO, the people on the team, clean financials, hiring a good M&A. Now, let's talk about what are some different ways that I can actually sell this thing, right? So what are the different sell types that I can do?
So there's a lot. There's a lot of ways.
Let's go to the highlights.
I don't want to talk about selling the company. Let's talk about liquidity strategies.
All right, let's do that.
At the end of the day, again, if this is an asset, I want to create liquidity from the asset. So let's talk about that for a moment, okay? There are non-dilutive ways to create liquidity where you still own all of the equity, but you are still able to get cash. So one very simple one is go to a senior bank, say, hey, you guys do dividend recaps. I would like to pull some money out of my company. That's one option. There are a number of private equity mezzanine capital lenders who will lend more expensive debt to you. Usually they want to see some aspect of growth or a reason to grow, but they will also allow you to take some chips off the table with that as well. So those are a couple ways. You can sell a minority stake to a third party, whether this is a family office, whether this is a private equity firm. That is more challenging, I will tell you. There's not a lot of people out there that want to take a passive minority equity position in a company unless it's at a significant scale. The scale typically will help in that conversation, especially if they're spitting off dividends and they see some value from a cash flow perspective. We could sell to something called an ESOP, which is an employee stock ownership plan. We could sell either 30% or all the way up to 100%. There could be some significant tax benefits depending on how that transaction is structured or how someone structures their own company. The key with that, though, is there's an idea that you want to give back to your employees and that you want to continue to own and control and grow the business, but you want your liquidity event. I don't want to get too in the weeds with this, but you're able to effectively turn a company that pays federal taxes or passes taxes on to its owners, and you can turn it into a completely tax-free entity through this transaction where it doesn't pay any taxes. The corporation maintains all of it, can pay its debt off much faster, and then it can use that capital to go acquire and grow the business even larger. We can sell to a private equity firm. There's a lot out there. I think the last I saw there is $2.2 trillion in dry powder. Dry powder is a fancy term for cash that they have not yet deployed. So
you said 2.2 trillion?
Oh yeah. Above million, above billion, trillion. Like, what is it?
A couple of dollars.
There's a lot of it out there.
Yeah.
They'll buy the majority of the company, and then they'll even want you to potentially roll equity over, which means that you have future upside to grow with them, with someone who's got deep pockets to be able to go and acquire and build and grow alongside of you. So it's not all your risk any longer. I've got a client that's following that strategy right now. He sold a couple of years ago to a private equity firm. They have done 4 or 5 acquisitions since that time, and they're looking at another exit next year. And he's going to actually receive more money on this next exit than he did on the first.
Yeah, and it's really interesting. I was talking with a gentleman yesterday. He just started up about a month ago with a company that's private equity held. And the curious thing is they're looking for that 3 to 5 year hold, right? That ideal is that 3-4 year hold. And they're not looking for perfection. They're looking just to improve it, to get that return, get that multiple, and then sell it to another PE, and they're going to tweak it just a little bit more. So you don't have to get it perfect. So that's, I guess, one thing that really opened up my eyes. We're not looking for perfection.
Not perfection.
Yeah, exactly. And leave some meat on the bone so you can get the next tranche and the next tranche, and it gives a little bit bigger each and every time. So I love that. So, okay, so we can sell part or, a portion of it to private equity or the whole thing to private equity, however we choose. And then what else?
Family offices are jumping in. And this is something interesting. Family offices are claiming they are patient capital. Some are, some aren't. That's for them to figure out. But family offices are rightfully getting into this space because they see an opportunity for them to impart their own wisdom, specifically in industries where they have had major success. Now, that's an interesting one because if they allow you to maintain some ownership for a family office and they have industry expertise, and you've seen that they have done what you're trying to do in your same space, that's an interesting player. And not to say they haven't been here for a while, but there are more of them today across every single size multiple that you can think of than there were, I'd say 10 years ago. And then the final and most obvious is you can sell to a competitor, a strategic buyer. They're going to want to buy everything. They typically should give the highest multiple. However, and something interesting, a client of ours that we've been talking with right now, they've been receiving offers to sell their company, and private equity actually came in about 10 to 15% higher than all of the strategics. So because of how much money private equity has and they have to put it to work, they're willing to pay more to compete for great businesses than some of the strategics would be, even though the strategics will be able to strip out a number of different inefficiencies and build on the synergies between the acquiring company and theirs.
Love it. Seller's market right now. Get after it. All right. So when you see people starting down this path, what's the biggest mistake that you see them make whenever they're thinking about exiting?
They jump to the transaction.
Unpack that a little bit.
So they jump to, okay, I want to sell. So that means I now need to go hire an investment banker. I need to go hire an M&A attorney. I need to go get a quality of earnings. They just jump to what they think they should do. They don't take a step back to start thinking about, okay, well, how's my company positioned in the market? Who's my team around me currently? What do I think that I might be able to get for this business? If I got that, how would I optimally want to structure this? Because at the end of the day, I'm selling it for X and I'm going to receive Y. Is Y going to be enough? Or do I have to wait because there's some gap between what I need at Y and what is actually going to happen? So there's all of this work and thought and conversations that have to occur well before it. Because what I've seen time and time again, and I'm probably going to continue to see it. I don't know if there's ever going to be a day where I won't see it, where someone sells their company. I talk to them after they sell their company and they say, I really wish that I would have known a couple things ahead of time, because whether it's estate taxes, whether it's income taxes, whether it's, state residency, whatever it might be, there's always something that they say, I wish I just would have known that, because I probably would have done something. But then I challenge them a little bit and I say, but would you have? Let's go back to that point in time. You were running so fast that effectively everything was just blowing past you. You couldn't read the sign that was coming right in front of you because it was just going too fast past you. So would you, if I presented that to you, would you have stopped? Would it have changed anything? Because I had someone who I shared all of this with, and he had the opportunity to just stop and blow up the entire thing. We actually had a meeting scheduled, but he signed the term sheet. And I said, why did you sign the term sheet? And he goes, because I thought that was what I should do. And I said, well, then why are we talking now? Because I don't want to blow up a good deal. You're still going to be very well off, but we were working on potentially adjusting this for you. And, in hindsight, he says, yeah, I should have taken a moment and slowed down.
Yeah. Now you get excited, right? The excitement of the moment. So slow down. Don't be the shoot, ready, aim, but think through it pretty well. No,
shoot the bullet and then try to run fast and catch it afterwards.
Yeah, exactly.
Because one or two things happens. Either you don't catch it, which typically happens, or it blows right through your hand.
Either one is bad. All right. Now, how about best business hack for us? If we're looking to exit or build to exit, whether it's hiring for talent or selling or for sales to build up the revenue, or scaling of the business for profitability and efficiency, one suggestion you would give us?
Build the leadership team. And make it a true leadership team. Don't make it one in name only, but make sure that those people have real, meaningful responsibilities within your organization. Make sure that they are taking on key roles, that you're giving them the authority that someone of that position requires and has the right to. and trust that they are doing it in your and the shareholders' best interest. And you do that by building the culture. You do that by creating this culture of growth, of value, of we want to build, we want to be better, we want to focus on the customer. And all of these things are cliches. Everyone knows them. But again, it's easier said than done. And I completely recognize that. But I'll eat my own cooking here. My father, Ami, who is the CEO of our company, through our transition, whenever we finally left UBS, launched Interchange, that was a major moment for him. He had already started building what he called the self-managing company. And he always said that he wanted that. And he was really, really struggling for a little bit afterwards, after the transition. So like, what do I do? You guys have everything taken care of. Like, I can't figure out, like, what should I be doing to continue to grow and add value? And I turned to him and I said, look, I think you built your self-managing company. Between me and Kendra, you're right. We have everything taken care of. So that now gives you the opportunity to, one, congratulate yourselves on reaching a major point that you always said you wanted to get to. But now that you're here, what do you want to spend your time doing? So he took some time off. He spent some time trying to figure that out. And now he's heading up all of the marketing and the engagement and the outreach from how do we position ourselves in the market, because that's what he loves to do. That's really what he enjoys spending his time on.
Nice. So really, I guess your suggestion then is know what you want and build it out, reverse engineer it, dream about it before you're actually there, and you're like, and you're in a crisis mode. Okay. Now, how about different resources that you might recommend? Books, podcasts, guides, personal or professional groups to join?
Yeah, I mean, look, if you're local to Pittsburgh, I would highly suggest starting to attend our exit plan chapters. We have them every other month. We try to make sure that the content is relevant to closely held and family-run businesses. A lot of the speakers are closely held and family-run CEOs and ex-family members. We have it every other month, and they're typically over at the Duquesne Club early morning. We try to get everyone out of there by 9:30. So, selfishly, I would love for everyone to come. It's a great group of people, and it's just a great experience, I think. And I'm not saying that because I'm not the only one that designed it. I've got 4 other co-founders of that chapter with me. Outside of that, there's a publication called the Family Business Magazine. They hold about 6 different conferences every single year. Their 2 premier ones are called the Transition Conferences. They have one on the East Coast. They have one on the West Coast. I would highly, highly suggest going there, spending some time. There are multi-generation family-run businesses that attend these, like up to 8 generations at some point, 100-plus-year-old companies. So, aspiring to be like them and learning of how did they do that and transition wealth as well as money and cash and everything else. It's really empowering to see that others have done this successfully, but then what does it take? And what are the potential things that you have to give up? Some of these people have some fractured families because of it, and they're working to rebuild, but the fractures still happen. So I think you need to go into this knowing that if you're going down the family business path, it's not an easy one. And that's, I think, a lot of times why people decide they do want to sell, because they want to keep their family intact, and that can help. However, there's a flip side to that. Significant liquid wealth can also fracture a family. So unfortunately, kind of damned if you do, damned if you don't. But there are complications that come whenever you've built something of significance, and not shying away from that and being realistic about it, and finding groups that have an expertise on working with multi-generational family-run businesses like ours. That will help you build some things that can mitigate and depersonalize some of the decisions that have to be made for the overall success of the families.
Now, you mentioned earlier there's about 2.2 or a little more than $2 trillion on the sidelines here, right? Yeah. So what's the future hold? How long does that stay in place? Does that grow? What's that look like?
I mean, don't hold me to anything I'm about to say. It's all my own personal opinion. I believe that as long as people continue to invest into the private equity space and invest in the private equity funds with their own capital, that this is going to run for a while. And closely held family businesses, at some point, everyone is going to have to figure out, do I want a partial liquidity event and sell and divest one of our business units, or is this an everything moment? Everyone's got to make that decision at some point, because you can't just continue to grow a business and allow the family tree to continue to branch out forever. At some point, there has to be this natural contraction of ownership, and unless that's going to be within one or two family factions, then private equity or strategic buyer is going to be the logical choice. So I think it goes on for some time. There are certainly headwinds that are coming, and I think we're going to start feeling those. As inflation continues, as interest rates continue to rise, I think we're going to start hopefully see a decrease in valuations. I think naturally these buyers have to underwrite companies differently from a value perspective. And when interest rates are low, values are going to be high. It's natural. So I think be on the lookout for valuations might come down, but they can't come down too much, because they're effectively artificially being propped up because there's just so much cash in the system going after these companies.
Yeah. Okay. Got it. Well, I appreciate it, Brian. So who should reach out to you? How should they reach out to you? And why should they reach out to you?
I'd say if you are a family member of a closely held business, or you own a closely held business, and you're looking for some ideas, some thoughts of how do you progress. Maybe you're at a crossroads in your own life personally, or you feel the business is at a crossroads. Send me an email. I'm sure Brian will put my contact information somewhere for you to get. Call me on my cell. I'm pretty open. I'm pretty candid, and I'll tell you what I think, good, bad, or otherwise.
There you go. It's good, bad, and ugly. Well, hey, Brian, I really appreciate it. So the curious thing is, right, nothing new under the sun. Build a good business, run a good business, keep good financials, hire good people, put good processes in place, sell good stuff, and actually deliver on brand promise. You do that, you can have a good shot of a good profitable exit multiple. So really appreciate it, Brian.
And one last aspect, a little bit of luck.
Yes, that's helpful.
Because I have found that right place, right time works, but I add another component. If you're not prepared to take advantage of that, then luck doesn't matter. So there's this preparation aspect as well. And you have to seize that moment whenever you see it and not shy away from it.
Yeah, you know what? That's a really good point, Brian, right? Because if you wait until you're ready, it's likely already too late. Build to that point, and that way you can capitalize on it. So that's a great parting thought. So remember, take application. Don't learn for learning's sake. Let's take application of this and go out and do it. Thanks, everyone. Help communities thrive through entrepreneurship. If you like these episodes, share it, like it, help us out. Let us know who you want to hear and what you want to hear, and we'll keep after it. Thanks, everyone. See you.